Nobody saw this coming. The entire auto industry spent a decade telling you that hybrids were a bridge technology, a stepping stone, something you buy on the way to buying an electric vehicle. And then, in 2025, hybrids became the fastest growing vehicle category in America. Not electric vehicles, hybrids. That is the contradiction at the center of this story. For years, the narrative was airtight. Electric vehicles were inevitable. Governments set deadlines. Investors poured money in. Automakers made public commitments worth tens of billions of dollars. Analysts at Boston Consulting Group said EVs would reach 50% of the American market by 2030. Ford, General Motors, and Volkswagen announced they were going all in on battery electric. Toyota was called behind the times for hedging its bets on hybrids. The company was publicly criticized for not committing fast enough to a fully electric future. The word hybrid started to feel like a relic, something your parents drove when they were trying to save on gas. Then the data started coming in. In the first quarter of 2024, battery electric vehicle sales in the United States grew only 5% year over year. That sounds modest, but the industry had been expecting double-digit growth. Meanwhile, hybrid sales surged 50% in the same quarter. That was not a blip. That was a signal that most people missed because it did not fit the story everyone had already agreed to tell. By the end of 2025, hybrids held nearly 20% of new vehicle sales in America. To put that in context, their market share in 2022 was roughly 6%. That is a tripling in under 3 years. And in the fourth quarter of 2025, battery electric vehicle sales actually declined 1.7% compared to the year before. That was the first annual decline in the modern electric vehicle era. Not a slowdown, a reversal. This is the part of the story that deserves your full attention, because the auto industry does not reverse course quickly. These are companies that plan in 5 and 10-year cycles. They commit billions to production lines that take years to reconfigure. When the data shows a reversal of this magnitude, something fundamental has changed in how real people are making real decisions with real money. So what happened? How did a technology that was supposed to be disappearing end up accelerating? The honest answer is that the problems with electric vehicles that critics pointed out for years turned out to be more stubborn than the optimists admitted. Range anxiety is the obvious one. Surveys from 2025 show that 71% of American drivers admit they would feel anxious driving a battery electric vehicle, and 29% say range is their single biggest concern. That number has not meaningfully improved despite years of range improvements from manufacturers. The anxiety is partly psychological, but it is also partly rational, because the second problem is charging infrastructure, and that problem turned out to be much harder to solve than the industry projected. 55% of potential buyers point to charging availability as a reason they are not purchasing an electric vehicle. 39% say they are worried about actually locating a charger when they need one. 37% worry about wait times at charging stations. And here's the detail that rarely gets discussed in the mainstream coverage. 32% cite high charging costs as a concern. The promise of cheap electricity as a fuel substitute has not materialized the way buyers expected. In many parts of the country, charging at a public station costs more than people anticipated, and in some cases approaches the per mile cost of gasoline for certain vehicles. Then there is price. 60% of American consumers who are not buying electric vehicles cite the high purchase price as the primary reason, and this problem got significantly worse in September of 2025, when the federal $7,500 tax credit for electric vehicle purchases was eliminated. That credit had been doing more work than most people realized. It was not just a discount, it was the psychological anchor that made the price comparison feel fair. Once it disappeared, the gap between what a hybrid costs and what a comparable electric vehicle costs widened in a way that changed the calculation for millions of buyers. The combination of these factors produced a shift in consumer intent that is almost impossible to ignore. Purchase intent surveys from 2025 show that 26% of American car buyers are planning to buy a hybrid. 5% are planning to buy a battery electric vehicle. That gap between 26 and 5 is not what the industry was projecting 5 years ago. It is not even close. Now, this is the part where the story gets more interesting than a simple EVs lost, hybrids won headline. The automakers who survived this shift are the ones who hedged. And the clearest example of that is Toyota. Toyota spent years being criticized for its hybrid strategy. While competitors were announcing all-electric futures and receiving praise from environmental advocates and investors alike, Toyota kept investing in hybrid technology. The company sold 4.4 1.43 million hybrid vehicles globally in 2025, up 7% from the previous year. In the United States, 47% of Toyota's vehicle sales were electrified vehicles, the majority of them hybrids, up 17.6% year over year. Toyota set a global sales record of 11.32 million vehicles in 2025. They are not just surviving this shift, they are the primary beneficiary of it. Honda is in a similar position. In May of 2026, Honda sold 42,583 hybrid vehicles in a single month, a company record. Total Honda sales were up 10.5%. The Accord hybrid alone grew 33.3%. These are not numbers from a company in trouble. These are numbers from a company whose strategic bet is paying off. Hyundai and Kia are seeing eco-friendly vehicles, including hybrids, account for 30.4% of their combined American sales. Ford, which had committed billions to its electric vehicle division and posted significant losses on those investments, began pivoting back toward hybrids for 2026. General Motors and Volkswagen, both of which had made sweeping announcements about their electric-only futures, quietly walked back timelines and added hybrid options to their lineups. This is what corporate surrender looks like when it is done carefully. Not a press conference admitting failure, just a product lineup that quietly looks different from what was announced 3 years earlier. The companies on the other side of this shift are facing a harder road. Tesla's global deliveries in 2025 fell to 1.64 million vehicles, a decline from 2024. In the United States, Tesla registrations dropped 6.8%, and the company's market share slipped to 44.9% of the American electric vehicle market, down 3.1 percentage points. In Europe, Tesla's electric vehicle registrations fell 45.2% in the first 5 months of 2025, compared to the same period the year before. That is not a rounding error. That is a structural change in how European consumers are responding to the brand. Rivian's first quarter 2025 deliveries declined 36%. The company cut its production guidance and reported a negative earnings outlook. Rivian is building genuinely impressive vehicles. The problem is that building impressive vehicles in a market that is growing more slowly than projected, at price points that require significant incentives to move, is a very difficult business model to sustain. Lucid saw a 58% increase in first quarter 2025 deliveries, but that growth came through significant price reductions. When you have to cut price substantially to grow sales, you are not winning, you are buying time. Here's what this actually means for the direction of the industry, and this is the part that tends to get lost in the debate between EV advocates and hybrid defenders. The hybrid comeback is not evidence that electric vehicles are a failed technology. Battery electric vehicles will continue to grow. The underlying technology is improving. Charging infrastructure is expanding, just more slowly than projected. The question that the data is answering right now is not, will EVs eventually dominate? Most serious analysts still believe they will. The question the data is answering is, how long will that take and what happens in the meantime? EY, the global consulting firm, now forecasts that electric vehicles will take 5 additional years beyond previous projections to reach 50% of the American market. The hybrid category is projected to peak at 34% of passenger vehicle sales by 2034. That is not a transition that was supposed to exist at that scale at that point in time. That is a decade-long detour that the industry did not plan for, and that is now forcing enormous strategic recalculations. The core insight is this: consumers did not reject the idea of cleaner, more efficient vehicles. They rejected the complications that came with the specific version of that transition that was being sold to them. A hybrid gives a driver 30 to 50% better fuel economy than a comparable gasoline vehicle, without requiring a home charger, without range planning, without the anxiety of finding a working public charger on a road trip, and without the premium purchase price. It offers most of the environmental and economic benefit with none of the behavioral change. For the majority of American drivers, that trade-off is currently more attractive than the alternative. And here is the question worth sitting with. If you are someone who was planning to buy an electric vehicle in the next 2 or 3 years, does the current state of charging infrastructure in your specific city, in the specific places you drive, actually support that decision comfortably? Or are you counting on improvements that have not arrived yet? That question is not an argument against electric vehicles. It is an honest look at the gap between the vision that was sold and the infrastructure that exists. The companies that understood that gap and built products to serve the customer who lives in that gap are the companies that are growing right now. The auto industry told a story for most of a decade. It was a confident story. It had government backing, investor momentum, and the kind of cultural energy that makes contrarian thinking feel foolish. And it was not entirely wrong. The direction was probably correct, but the timeline, the pace, the assumption that consumers would adapt faster than infrastructure could be built, and the belief that price would not remain a central barrier after subsidies were in place. Those assumptions turned out to be more fragile than the people making them wanted to admit. That is what the hybrid comeback is actually about. Not the technology, not the vehicles themselves. It is about what happens when an industry's vision of the future runs ahead of the conditions that would make that future possible. And it is about which companies were humble enough to keep building for the customer who exists today, while also preparing for the customer who will exist tomorrow. For the full picture of what is actually happening inside the auto industry, and for the next shift that most people are not talking about yet, subscribe so you do not get caught off guard by what is coming.